the next several months. Now, that being said, I want to bring it over to our guest speaker for the day. Once again, this is Todd Swanson, a mortgage consultant, president of Swanson Lending. And without further ado, Todd, I'll turn it over to you. Thank you so much for being here today.
Thank you. Thank you, Brian. Kent. I'm a big fan of Meridian Pacific. Full disclosure, I own a couple of properties that Meridian's built. Been very happy with the turnkey experience with that. I continue to be impressed with the values that Meridian has displayed. In my business, I do business by relationship. I don't advertise to the general public. So everybody that I do business with has introduced me by somebody I know. And that seems to be Meridian's model as well. And I've been impressed with that with every client that we've worked together on. So thank you for inviting me here today. My background, I obtained my real estate license in 1993. So I've had a fascination and interest in real estate since, a young adult, and obtained my broker's license. That's the higher license here in California in 2008. And after a bad experience with a loan officer who lied to me, I looked into what it took to become a mortgage broker. And in 2002, I became a mortgage broker and realized this was where I was meant to be. So for the last 20 years, I've been helping people finance the American dream. In 2006, I became a certified mortgage planning specialist, which is really, it's financial planner training for loan officers. So I look at a mortgage as a financial tool that should be woven into the short and long-term financial plans of my clients, that we should talk about their insurance, even though I don't sell insurance, that we should talk about their investment plans, even though I don't sell investment products. And 2000, I started investing in real estate, and that's, again, part of how I became a mortgage broker. I recently retired in December from the Marine Corps Reserve, and that experience, a little over 30 years in the Marine Corps, colors how I do things, how I see the world a little bit. And so you'll see that probably here in this presentation. Brian, next slide. So I'm going to talk about two broad categories here. The first is mortgage product opportunities, things that have come to market that can help mitigate risk for investors, can help with cash flow. And then the second category there is the interest rate market changes and some strategies around how to handle what's going on with the market. So the passage of the Dodd-Frank law back in, 2008, 2009, I think, bifurcated mortgages into two products. You got qualified mortgages. That's the stuff that Fannie Mae, Freddie Mac can buy. It put strict standards on underwriting, and it limited features that Fannie and Freddie were no longer allowed to offer. And everything else, those other features, became non-qualified mortgages. Those are products with alternative qualifying criteria. They have some features that are no longer allowed in the qualified mortgage. There's rules on both. In general, I think the positives, there were some negatives to that law, but in general, it made shored up underwriting standards. So the shenanigans that was going on in 2005, 2006 just really can't occur now. So today I'm going to talk about three of those non-QM or non-qualified mortgage products. The first is the debt service coverage ratio. And that product really is designed for qualifying off of the rents off the property. Risk for the lender is mitigated through the equity contribution of the investor and the FICO score of the investor. So got to have a good FICO score. And it allows an investor to go in and do some things that they couldn't otherwise do. So if somebody has more than 10 financed properties, that's a qualified mortgage rule. Fannie Freddie can't finance an 11th property. The debt service coverage ratio doesn't have that rule. It also allows somebody that doesn't have, and dovetailing into the bank statements there too, somebody that doesn't have the type of income that can meet your standard underwriting guidelines. You think somebody that's got W-2 or a business that's highly profitable on, let's say, the tax returns. Some businesses have a lot of revenue. That's where the bank statements come in. We can show that this person has revenue and they underwrite based on 12 or 24 months of bank statements. They don't look at tax returns. Debt service coverage doesn't look at tax returns. It strictly looks at the market value of the rents for that property and how it covers the payment. Asset depletion. This again is another tool for an investor that may have a lot of liquid assets. We can impute an income based on those assets. So just simple math example here. Each lender has a slightly different criteria how they do this. But let's say an investor had $120,000 liquid and the investor's rule was to divide that by 120 months, that would mean we'd be able to add $1,000 a month to the investor's qualifying income. And some of these products, the bank statements and asset depletion with some of our lenders can be combined. So we can pump up the income on the asset side and show revenues through the bank statements to help the investor qualify. So non-QM products have features like not qualifying with the tax returns. A great example of this would be a business owner that sold their business. They've now done away with their income source by selling the business, have a large amount of assets. That's where the asset depletion would come in. So the non-QM products fit that sort of a scenario. We can also close in a limited liability company. Fannie Mae and Freddie Mac only lend to human beings. They allow more than 10 finance properties, I already mentioned. They have a 40-year fixed, some of these products. So it's an interest rate that will not change. If the investor kept the loan the entire 40 years, the interest rate will never change. And then they offer the interest-only feature. And so my next bullet point there is an interest-only risky? Well, it depends. It depends on how it's going to be used and the product that it's used with. And so what I put there, the fixed or variable, you go back to prior to the financial crisis, interest-only was almost always paired with a variable rate product, meaning an ARM product, meaning something that the interest rate might be fixed for 3 years, 5 years, 7 years. And after that period, the interest rate would become variable. So the investor would now have an interest rate volatility risk. But then also the interest-only period, in some cases, ended at the 3 years or ended at 10 years. And so you could also have an amortization risk with that. And so it depends on how it's used. I like the 40-year fix because there's no interest rate volatility. It's a fixed rate, never going to change. And the interest-only period being at 10 years with all of the products I've looked at recently means that the investor essentially, if they pay just the interest-only, they slide into a 30-year fixed-rate mortgage at rental rates that very likely are higher. There's probably more cash flow in 10 years. So that's one of the benefits of the interest-only loan is that increased cash flow can lower risk. Most investors that I've seen over my career that have gotten into trouble first didn't have sufficient liquidity. They put too much into their investments and left nothing in the bank. And then secondary to that, didn't have enough cash flow. So if you have more cash flow, you can build liquidity and you can weather any vacancy or damage if a tenant did it, that sort of thing, by having cash on the sidelines. Additionally, and this is unique to the interest only, it creates a higher internal rate of return for the property. And the simple way to think about that is that with an amortized loan, each month that you're making a payment, you're adding to your down payment in a way. So you're growing an equity stake in the property. And so if the property goes up 5%, it's over a growing larger equity stake. And for that reason, an interest-only loan can raise the internal rate of return of the investment. Let's go to the next slide. So shifting to interest rates then, this is what's happened. In December, we were running scenarios for clients. I think 25% down as the slide shows, 3.625, no points. Today, we're looking at 5.5. I just reran it this morning, 5.5 at 1 point. And 1 point is 1% of the loan amount. That's a fee to buy the rate down. If an investor did not want to buy the rate down, we'd be looking at 5.875 today. So rates have risen considerably. So why is that? Well, the Federal Reserve's favorite measure of inflation is the Personal Consumption Expenditure Index. And that, as you see there up in the upper left, has been rising. That's at 6.4%. That's the highest it's been in 40 years. Additionally, with the Fed chart there, what I'm showing is the other thing that the Federal Reserve fears, which is that incomes are also rising at a pretty good pace. They call that wage-based inflation. And if you look at the 1970s, that's kind of what occurred. Prices were going up, wages went up, and it was a vicious cycle of allowing prices to continue to go up because wages were continuing to go up. If wages aren't rising, then prices have a ceiling at some point. They become unaffordable, demand drops. But if wages continue to rise, prices can continue to rise. So let's go to the next slide. So why have mortgage interest rates risen? Well, this complicated chart, it's up because if you follow it, it shows that mortgages are funded by a bank and then sold to Fannie Mae and Freddie Mac. They're then put into a bond pool. sold to investors. Many of us, if we have money market funds or bond funds in our 401k, we own mortgages because they're mortgage-backed securities. That's what the MBS stands for. And in a rising interest rate, or pardon me, rising inflation environment, the value of a bond investment declines. So investors demand a higher interest rate. So that's the major reason. Now, in addition to that, the major buyer has been the Federal Reserve. What you see there in this chart in the bottom right in red are the mortgage-backed security purchases that the Federal Reserve has been making since about 2009. And if you look at those periods like 2010, 2012, they tapered their buying of these bonds. And then most recently, 2019. In all of those periods, rates began to rise. So just on Monday, the vice chair of the Federal Reserve, that's the quote that she issued. She expects balance sheet to shrink considerably more rapidly. That hurt the bond market. We were looking like we were going to start trading sideways. Let's go to the next chart, Brian. This is the daily trading of the mortgage-backed security as of, I think this is Monday, as of Monday. When this bond chart goes down, interest rates go up. And so as you see, it's been heading down. We had a few days there down in the bottom right where it looked like it was starting to kind of trend sideways. I have a red-green color deficiency, so normally that yellow-orange color would be red, meaning that it traded down on the day. And as you see on Monday there on the far right, after the vice chair spoke, it closed down. And so we're back down into a down trend in rates. So for the foreseeable future, until the Federal Reserve stops jawboning rates higher, we're going to continue to see interest rates rising. Next slide. So that begs the question then, will rising interest rates cause housing prices to fall? The chart you're seeing is from a study that Freddie Mac did in 2016, where they looked at the effect of rising interest rates, and that's in the black there at the bottom, how much the rate went up during those periods. And they compared it against housing prices. And what they found is there's a very, very minimal correlation between rising interest rates and rising prices. And this is something that, I had to think about a little bit, but the Freddie Mac report spelled it out. It's that fewer sellers sell, just like fewer buyers buy. So we'll see fewer transactions in a given market typically because sellers end up becoming buyers. It's not like they're going to pitch a tent next to the freeway, hopefully. Next slide. Looking at it in a more extreme price changes where we've had more than 2% interest rates, just kind of back that up, we still had housing price increases during those periods. So will this cause a recession? Rising interest rates, the Federal Reserve has a long history of pushing interest rates too high, too fast, too far. And what you see there in yellow are periods where the 2-year Treasury bond produced a higher yield, a greater rate of return, than the 10-year Treasury bond. They call that the inversion of the yield curve. And if you notice, the gray bars are periods of recession in the US economy. Every recession has been preceded by an inversion of the yield curve. In some cases, you look at that period in the late 90s, early 2000s, it inverted twice before that recession. What we're seeing on the far right there, you see before 2020, there was a very small dip, but it did invert. And if we go to the next slide, this is the 1-year chart. And you see just this week at the bottom right there, the yield curve inverted again. So this is one of those measures that every recession has been preceded by yield curves. So it's an indicator that we may be at some point 6 months, 24 months out from a recession. It's not an exact science, but it is an indicator saying that we're probably heading to recession. So if we go to the next slide, another common indicator of recession, this has about an 80% probability of being right, is the price of oil spiking in this index. When it goes above that 50 mark, it precedes a recession. And here we've hit that recently with Brent crude spiking. So we've got two indicators that are saying we may be heading into a recession. So let's go to the next slide. Will a recession cause a decline in housing prices? And the answer to that really seems to be, it depends on what caused the recession. 1991, that was really driven by the 1986 tax law change that heavily affected real estate. Prior to that, a doctor, a lawyer could go buy real estate, negative cash flow, and shelter their earned income The 86 tax law changed that. It capped the amount of depreciable loss that someone could take and capped the income level that they could take it at. So we started to see a shift in real estate. At the same time, that tax law affected the savings and loans institutions, which is at that period, 40% of America obtained their mortgages through them. So it became harder to obtain mortgages because 2,300 of those institutions went out of business during that period, while there was a disincentive to be a real estate investor. And so by 1991, we also know the Gulf War, we had an oil price spike there. So in 1991, we did see a very small decline in housing prices, really driven by that real estate and banking crisis. In 2008, again, we had a banking crisis, which, simplifying both of those, it became much harder to obtain a mortgage, which means we pulled buyers out of the market, but we still had the same number of sellers. So whereas interest rates affect both sides of the balance sheet, credit qualifying affects just the buy side far more heavily. So going to the next slide. One of the other factors that we have that I don't think we're going to see a decline in housing values is that inventory is at a record low. Kent's chart that he showed earlier went through December. This is through February, and it's 380,000 listings nationwide. That represents a 1.7 month supply based on the number of sales the prior month. That is just unbelievably low. A balanced market is considered 6 months of inventory. So we're heavily skewed to the sell side of the market. Additionally, new construction isn't yet poised to make up that difference in demand. Over the last 15 years, we've had more growth in households, more growth in the population than we've had new construction. NAR recently came out, the National Association of Realtors, and said that we're about 4 million houses short of what we need for the population growth. And we've underbuilt for the last 13 years. We've underbuilt that 50-year average. So there's room to make it up. And, so I'm cheering Meridian on. Keep going, guys. Let's go to the next slide there. So the Burns Real Estate Index, I'm going to look at will rents fall? Will the recession cause rents to fall? According to John Burns, with this chart going back to 1985, there was no year that was negative via his methodology. The worst year for growth in rents was 2010. It was 0.3%, not quite far less than 1%. If we go to the next slide, this is CoreLogic's methodology. They have a different methodology, smaller sample size of homes. And they saw a 3.9% decline in 2009. That, when you're looking at the homes Meridian is building, rents around, say, $1,950 a month, a lot of these, that represents about a $75 per month decline in rents for 1 year. But you go forward in this chart to 2010, and you're back to a 3% increase in rents. So any decline via the CoreLogic methodology is quickly made up. It was a 1 year dip. So it's pretty true to say that rents really don't decline. Are rising rents and rising home prices sustainable is the next really great question to ask. And what this chart is showing is the income growth from 2010 to 2020 to 2021. Every state in the country saw incomes increase. Vermont up there in the far right is the laggard at 4.5%. But the markets we care about here, because they're Memphis, is Tennessee, Arkansas, and Mississippi. And as you can see, 7.2 for Mississippi, 8.1 for Arkansas, 8.9 for Tennessee. And when I pulled the Memphis metropolitan statistical area, it was about 7.2 for that whole metropolitan area. So that's a strong growth in income. And there's a rule of thumb in the mortgage industry that if housing prices go up 5%, you need median income to go up about 1% for that 30-year fixed payment to stay in ratio, to stay affordable. So the fact that we're growing at 7.2% says there's plenty of room for rents to rise as well as prices. All right, so conventional wisdom says that interest rate is the most important factor. I hear that a lot, in quotes that clients get. Get this rate, do this thing. That's the most important factor. But when you look at how mortgages are priced based on that logic, then Fannie Mae considers the lowest risk mortgage, the best price mortgage, one that's 60% loan to value or lower. So therefore, by that logic, investors should put 40% down every time. A 15-year fixed mortgage is also a lower rate than a 30-year. And of course, there's the maximum buy down, paying 2% of the loan amount to buy that interest rate down. But saying that out loud to investors, kind of nonsensical, because it ties up a ton of capital. It lowers the investor's rate of return. So interest rate is not, in a lot of cases, is not the primary factor, and in some cases may not be very relevant in the decision matrix. So let's talk about some strategies. Let's go to the next slide. Talk about some strategies on how to deal with the current rate environment and rates continuing to rise. The first one that jumps out to me, over the years, a lot of investors that I've spoken to aren't doing tax planning around the real estate. They're kind of letting their tax preparer prep their tax return. They don't know about cost segregation. And that's just one specific strategy. But to dive into that, that's taking some of your depreciation, a big front load of your depreciation up front. So an investor that has other properties that are heavily cash flowing, they can buy a new property, do the cost segregation, get a big bunch of depreciation up front, and cover up that positive cash flow, get it tax-free from those other properties. Which means when you look at your blended portfolio of investment property, you create a higher rate of return by doing that, by doing some tax planning. So that can mitigate any rise in rates. Larger down payment, even if it's temporary. We're seeing housing values go up considerably. Zillow, which I almost need to say this tongue in cheek because their model of valuing homes isn't so accurate, but they're calling for an 18% increase in housing values nationwide this year. They just put that out last week. Other metrics, NAR, being that we're 4 million short, I do think that's probably there. So any larger down payment could potentially be refied out later, but that would be a way to manage the cash flow. But you could buy down the rate. When I was pricing that out, a traditional buy down, normally paying 2% of the loan amount, would only get a 0.5 point reduction in rate. In this current market, I'm seeing a 3/4 reduction there. So 5.5 versus 4.75. There's an opportunity there. Consider alternative products, whether it's the 40-year fixed, the interest only. In some cases, I've seen some ARM products, 7 or 10-year ARMs. These are 30-year loans where the rate's fixed for 7 or 10 years. And if that meets the investor's time horizon for ownership, that could be a good product. So look at alternative products. And then be prepared for rates to fall. And really what I'm thinking there is in recessions, interest rates decline. So as you're planning your business, a sale of a business, you're planning your other investments, you're moving money around, keep an eye to being able to qualify for the mortgage you want if rates do fall, if we do fall into recession, which I do think we will, and rates fall in a recession. So I believe there will be opportunities to refinance during that period. And so be prepared for that, because while you may have an interest rate on the acquisition now that you're not thrilled about, there'll be an opportunity to get a lower one in the future. Interest rate's only one factor in determining payment, and payment is only one factor in determining rate of return. Other considerations that may trump the rate are that the constraining factors of the investor. So for example, in the earlier example I gave about an investor who sold his business, has a large amount of assets, getting the loan and in this environment where housing values are going up, where rents are going up, that may trump any concern about, did I get the ideal interest rate? Did I time the interest rate market perfectly? If you're going to make a profitable investment, make the investment, and the interest rate is what it is. Time horizon's another factor. We're not day trading with real estate. It doesn't go up and down 30% in a day. These are longer term investments. They're illiquid investments. So looking at them as Meridian does over a 10-year time horizon, I think is a good lens to look at it. And in the short term, while we're experiencing inflation, remember, real estate is historically a hedge against inflation. So I think I covered where interest rates are at. I covered some alternative mortgage products. So I'm gonna turn it over back to you, Brian.
Awesome. Hey, thank you so much, Todd. That was fantastic. Let's go over to Wendy, and I think we have one question here in the chat box, but